Greetings everyone. I hope you're all doing good. This is Addhyann. I'm the Senior Faculty Head of Addhyann. Let's have a discussion about the very basics of the stock market, that is candlestick patterns. This is the most important topic to be discussed when it comes to technical analysis. This is the very basic thing that every trader should know before they start technical analysis. So I'm going to introduce you to the very basic candlesticks. There are two types of candlesticks that you can see here. One is red candle and second one is green candle. Let's understand what is red candle is all about and what is green candle is all about. Now before we get into the candlesticks, let's understand how a candlestick looks. So this is how a candlestick looks like, and the solid body part is called the body of the candle, and the upper line and the lower line are called wicks. So this is called the body, and the upper two lines, the upper line and the lower line, will be called as the wicks of the candlestick. Let's understand the red candle first. So this particular candlestick will represent the price movement in that particular frame of time. Let's say you are checking for 5 minutes. So in that span of 5 minutes, whatever the price move that has happened in this particular stock with the movement of price, is what the red candle is showing you. Now, what happened is the candle has opened at, let's say, 9:30 in the morning. It opened at this price. This is the open, and it went to a high of this price till this wick. So the edge of the wick will be the highest price, and the starting of the upper body is called open. This is where market opened. The price has opened. It went to a high of the wick, and the price movement, if you can see, the arrow mark is showing that the price is falling. It went to a low of the wick. This is the lowest price of that particular candlestick. So this is the lowest price of the candle. So the price has reached this much low and finally closed at the lower part of the body. So upper part of the body is called open price. The highest wick is called high price. The lowest wick is called low price, and the lower body part is called closing price. So if you want to interpret this particular move in a line form, here the market has opened, the price has opened here. It went till a high of this in this direction. It first went up and finally came down in this direction to this low, and finally closed at this closing price. So this is the movement of price that we can understand with respect to the red candle. Now let's understand the green candle. Green candle operates exactly opposite to the red candle. Let's say at 9:30 the price has opened at this point, and market has reached a low of this price, low price, and finally, if you can see the direction, the price is moving up. So it has moved up to a high of this wick and finally closed at this wick. That means this is a positive candle, this is a negative candle. So if the opening is greater than the closing price, then it will be a red candle. If the opening price is lesser than the closing price, then it is called a green candle. So the high price and low price will be same forever, but the open and close will be differed between the colors. So when the opening price is lesser than the closing price, then the color will be formed is green. When the opening price is greater than the closing price, then the color will be red. Now let's understand the movement of green candle. It has opened here. It went to a low, which went down to a lowest price here, and went up to a high of here and closed here. So in this way, the green candle is formed. Now these are the very basic candles that you generally see in your stock charts. So we will be discussing about few more types of candles which we observe in our daily charts. That is, this candle doesn't have an upper wick. That means if this is a green candle, then the closing price is equal to the high price because there is no wick. That means wherever the candle has closed, it is the highest price in that frame of time. So that is why the closing is equal to high. Here, this is a red candle with no lower wick. That means the closing price of this red candle is the lowest price of that particular time frame. So these are the two types of candles you observe with no upper wick and no lower wick. And the third type of candle you observe is a candle with no wicks at all. That means you will see only a body. If this is a green candle, then this will be the opening price, which will be my low price. This will be the closing price, which will be my high price. So this is the third type of candle that you observe. Fourth type of candle is where you see the wicks, but there is no body at all. That means this is a neutral candle with no color. When you don't see any color, that means there is no movement in the price in that whole period of time. That means open price is equal to closing price with no movement. But high, it went high and it went low, but it has closed exactly at its opening price. That means there is no move happened in this particular frame of time. The last type of candle that you will observe is no wick with no body. It is a plain flat horizontal line that you observe instead of a candle. That means the opening price is equal to the closing price is equal to the high price is equal to the low price. It opened there, it didn't move anywhere and closed there. So this is the different types of candles that you observe generally in the markets. Now let's talk about the different time frames of candlesticks. So you have an option to put whatever, you have option to opt whatever time frame you want to trade. So the price will have an as minimum as 1 minute to as maximum as 1 month. So if you want to trade in a shorter time frame, if you want to catch a smaller price moves, then generally you will go with 1 minute or 5 minutes. If you want to see the bigger moves in a day, to capture some bigger moves in a day, you will go for 1 hour. If you want to understand any positional trades or longer period trades, then you will go with 1 day or 1 week. Now, if you want to understand the bigger picture of that particular stock, then you have to go with 1 month. That means whatever the candle you are seeing here is a limit of 1 minute. So whatever the price moved in that particular minute is created as a candle. Here it is 5 minutes. This is a 1 hour period candle. This is a whole day. That means from 9:15 to 3:30 candle. This is from Monday to Friday candle. This is the whole month from January 1st to January 31st. So this is how you can change the time frame to understand a multiple time frame scenarios. So this is the different time frames of the candlesticks that you can observe. So let's understand different types of trends. So we have 3 types of trends. One is upper trend, one is downtrend, and the third type of trend is sideways trend. So let's understand how to define a trend. Once the price has moved from a lower level to higher level, then we will have a low and a high. We got a low price and a high price. Now, after that, the price falls and create one more low, which is higher than the previous low. That is the reason it is called a higher low. Now, if the price moves up again, it will create one more high, which is higher than the previous high. In this way, it will create higher highs and higher lows always while the price is moving up. So once you see this particular pattern where the higher highs and higher lows are created together, it is called an uptrend. When you have a range of high to low, when the market has fallen from a particular price to a low, where it has created a high and low, and once the market moved up, it has created one more high which is lesser than the previous high, then it is called a lower high. Then it creates one more low which is lesser than the previous low. In this way, the price creates the lower highs and lower lows together, then it is called a low trend. I'm sorry, it is called a downtrend. This is called an uptrend, this is called a downtrend. Now, if the price stays in the same range the whole day, then it is called sideways, where you won't see any higher highs, you won't see any lower lows, but the range will maintain the same the whole day, then the trend is called sideways trend. Generally, we need to take trades. The safer way of taking a trade is in uptrend or a downtrend. Usually beginners should avoid trading in a sideways trend. So when the price is moving up, it's a good way of taking a buy. When the price is falling down, it's a good way of taking a sell. So in this way, we can avoid sideways trend and we can trade in uptrend and downtrend based on the scenario. Let's understand three important candlestick patterns. These are very, very important for understanding an entry and a trend as well. The first candle that we are going to see is a doji candle, where the doji candle won't be having any body, but it will be having the wicks with no body. That means the open is equal to close. So this represents a stop in the trend or a pause in the trend, or you can say a consolidation happened in the trend. So this will give us a very good confirmation that the trend is going to reverse or the trend is going to continue. So whenever the price is moving up, it will take a pause before it can continue the trend or reverse a trend. So whenever you see this at a strong resistance or support, that we can understand it took a pause. Now the trend can continue or trend can reverse. The second one is a hammer candle, which is a positive candle. If at all this kind of candle you observe at a strong support, it can give you a very good confirmation that the price is moving up. So the trend is going to be a positive trend, is what? An uptrend. This can give you a confirmation about an uptrend whenever you see this at a support level or a moving average. The third one is a shooting star, which is exactly opposite to the hammer candle. If this appears at a strong resistance, then we can confirm that the trend is going to be a downtrend. So these are the three candles which are very, very essential for taking an entry in a longer period of trades, like positional trades. Now, doji, hammer candle and shooting star are the three important confirmations for any trend. Doji is a neutral confirmation for any trend. It can be for an uptrend or a reversal. It can be an uptrend. Hammer candlestick is a confirmation for an uptrend. Shooting star is a confirmation for a downtrend. So we will be discussing about the strategy now. The strategy that I'm going to explain you is a moving average based strategy. So let's understand what is a moving average. Moving average is nothing but the averages of all the prices from last n number of trading days. So the moving average can be calculated using the formula P1 plus P2 plus P3 so on till Pn divided by n, where n is number of trading sessions and P can be high, low, close or open. So in this way, for every candle you will get a new average value that will be formed. If you connect all the dots, you will get a moving average. You will get a moving average line. Let's understand the strategy details now. Let's see the buy entry first. Later on, we'll see the sell entry conditions. Then we will get into the chart and I'll explain you with the help of the stock chart. So the buy entry it's that simple, as we have discussed about a doji candle and a hammer candlestick. If any of these two forms at the 50 moving average with the help of high, here the P is high. So you are taking 50 moving average. That means you are collecting the average values of last 50 trading sessions with high prices. If that particular moving average line is above 50 moving average line, and if you get a doji candle or a hammer candlestick which is forming above the 50 moving average high, and at the same time if the whole scenario is happening below 200 moving average, that means all these price 50 moving average high and 50 moving average low are below 200 moving average with a closing price, then this is going to be a buy signal for us, and you have to buy it at the high of the doji candle or the hammer candle, and the stop loss is nothing but the 50 moving average low. So this is the buy entry conditions. Let's discuss about the sell entry conditions as well. So we will be understanding the sell entry conditions as well using the moving averages. You need to sell at the low of the doji or a shooting star which is formed at 50 moving average low. So what happens here is the order should be, top should be 200 moving average, and the middle should be 50 moving average high, and the low should be 50 moving average with low. And at the 50 moving average low, at the last line, that is 50 moving average low, there should be a doji formation or a shooting star formation at that line. Once it is formed, the low of the shooting star or the doji candle will be your sell signal. Now let's understand the same strategy using the help of charts. So we will be looking at the Nifty chart with 1 day time frame. This is 1 day time frame. If you want to change it into another time frame, you will be having 1 minute, 3 minutes, 5 minutes, 45, 1 hour. So I'm using 1 day time frame, and the top line, the top red line is 50 moving average high, and the below line is 50 moving average low, and the lower blue line is 200 moving average close. If you can see, 50 moving average high, 50 moving average low, and 200 moving average close. Now the condition of buy is pretty simple. You need to wait for a doji formation at 50 moving average high. Now if you can see here, I can see a doji formation at 50 moving average where the 200 moving average is completely at the bottom, the 50 moving average low is below, and 50 moving average high is at the top, and a doji formation has been happened. So this is the point where we will be buying at the high of the doji candle. So once the high is broken, you will be entering a buy. Now you can see what happened. The market really went up. Now where will you be exiting this trade? As I said, the stop loss will be 50 moving average low. You can see the 50 moving average low has been touched by the candle. So from 11,700, it has closed at 13,600. So these are the huge points that we could have made if we used a simple moving average strategy. Now let's understand the selling scenario as well. Now let's see the selling scenario as well, and you can see the 200 moving average is at the top, and 50 moving average is at the bottom, and 50 moving average low is at the bottom. Now If you can see the doji formation over here on the lower side where 200 moving average is at the top. So this is the signal that we are looking for. And once the doji has been broken at the low side, we will be entering into a sell. Now the stop loss, as I said, the stop loss will be 50 moving average high. So the moment 50 moving average high is touched, you will be exiting the trade. So this is the very simplistic strategy that anybody can use with any time frame. So let me show you a smaller time frame trades as well. So this is a 15 minutes time frame if you can observe. So the 15 moving average high, low and close. So the blue line will be 200, 50 high and 50 low. Now if you can see, if you can observe here, we got a good rejection over here and the market went up. So this is a very simple trade that we can take, and the stop loss has been hit, but the target you could have booked by the time where we have booked our losses. Here we got the doji candle, more of a hammer candle if I can say. So once this high is broken, we got the buy entry and you can see the market went up. So where we could have booked our losses, where we could have booked our stop losses somewhere here. So from here to here, we could have trailed our stop loss at 50 moving average low. So this is how you can use this particular strategy in a bigger time frame and a smaller time frame as well. So I hope you understood all the basics of candlesticks and time frames, the basic market trends, and finally the strategy. I hope everybody liked. If you have any queries, you can contact our team management. They will guide you with proper solutions. I wish you all the best. Thank you so much for your